I was asked to just put together a short presentation on how an investor looks at this sector. So I'm going to tell you as I see it. We all know mining has been around and we owe a lot to mining. So I think, first of all, key to remember, 43,000 years ago, the first mine was in Switzerland. So Africa has a lot of catching up to do. Civilization is where it is because of mining. And we owe a lot of our technical advantage because we were mining. So it's core to our survival that we continue. Iron, copper, bauxite, silicon, carbon, gold, coal. Maybe not so much gold, but everyone likes gold, but it's not critical. Lithium, tantalum, uranium, cobalt. If any of these stopped being produced, our lives would suffer. So it's critical that we recognize the importance of mining. Mining wasn't, maybe is a core pillar of financial markets. That's partly why I'm going to be giving you this talk. And I think it's fair to recognize the role mines play in a lot of communities in terms of being a major employer. So those are the important factors before we dig into and beat up mining. These are the main indices in the mining sector. Most of you are familiar with them. I don't know how many of you spend time just looking at how these sectors perform. Because I think before we start talking about investors' perspective, we should just talk about investments and investors. Investors only invest money to make money. That's the purpose of it, yeah? There's no love of mining, no love of production, and certainly no love of exploration. They just want to make money. And it is important to them that they do it responsibly, but if they don't make money, they don't eat, and they get into a situation where they have to redeem the funds that they've raised. Funds have mandates, they have to stick within those mandates, and a fund is set up with clear guidelines of what they will and what they won't do. So a lot of times when you say, oh, why isn't a fund doing this or why isn't a fund doing that, look at their mandate. Their mandate defines what they're allowed to invest in, what they're not allowed to invest in. It's clear. But one of the things they all try to do is make money. So if they can't make money, then they're not going to invest. If we take a look at these indices over the last 5 to 6 years, 10 years, there's just one thing common. Volatile. So what that means is, depending on where you come in, how do you operate this? How do you make it laser? Is it the front?
Red one.
Red one, I can't see that. Okay, never mind.
Hang on, I'll show you.
Okay. So if you come in at the top there and you buy in, you don't have a good story to tell. If you come in at the bottom here, you think you're fantastic over here and you can't believe your luck that you didn't sell out there. So how do you play this game? Yeah? What do? How do you ensure that you don't buy up there and you don't sell down here? This is the issue. Let's just take a look at what some other people do. They go for the less risky, less sexy indices. But the reality is if they ride that wave, they experience a very different investment profile. And that's the competition. Yeah, mining is just another sector, and it's just another opportunity for an investor to put money in. Where do they put their money? Do they go into techs? Do they go into pharmaceuticals? Do they go into mining? Obviously, when a pension fund places investments, they do it on the basis of every one of us. When we take out our pensions, you remember you fill in the forms and you put down where you want to put your money and how you do it? Well, that translates into investment orders eventually, and that pension fund has to live by and abide by your guidelines. You said you want 30% of your pension to go into this, 25% of it into that, and 35%. So they have to manage that money and make sure that that happens. If you said in that form you want to be in mining, they'll put your money in mining. If you say you don't want mining, they're not going to put it in mining. So obviously there's an element of risk that pension funds follow. Private equity follows a different game. Each investment vehicle follows its own game with its own mandate. But one thing is clear. If I invested in NASDAQ over here, and I sold over here, or over here, I'm not losing money. This is the key thing. On any 12-month cycle, I invest in NASDAQ, I don't lose money. Well, I might lose money if I go from there to there, but any 12-month cycle, you measure on there, you don't lose money. And that's what we try to do now, just to compare these indices, to see how it works. So mining indices, recognize that over the last 5 years, they're all up. So it's not all bad, apart from S&P TSX, that's not us. But all the others are up. So it's not like over a 5-year period you lost money. But what's more important to recognize is that our benchmark grew by 250% over 5 years, and that during that same period, investors who were in mining experienced a much more volatile market. So, you know, as Auntie Betty might have been looking at her investment portfolio, she might have had a heart attack during 2009, whereas if she was in NASDAQ, she wouldn't have had such a bad time. Same way, benchmark has grown in value over any 12-month window, which means that even on a medium-term investment, you won't have lost your money. Benchmark is heavily traded, so you want to get in, you want to get out, it's easy. Whereas if you're invested in mining stocks, there are times when you have an illiquid market, you can't get out. These are the realities of our environment. So as operators in this environment, we all have to recognize this. If you stick your head in the sand, well, fine, okay, great. But then don't come complaining to me when you want me to raise you money and I say I can't. Because you're ignoring the realities. This is an interesting benchmark because the MSCI actually they produce results like this, which really beggars belief. But there you go. There's the mining index. You can see it follows very similar to the world index. World index is all the other industries piled together, and you can see the patterns are the same, but the volatility isn't there. You can see here when they start measuring the performances, how the mining sector really drags behind the rest of the sectors. And we can see from their statistics that the standard deviation, how many of you here do standard deviation? Sorry if you do. Well, it means big number is not good in standard deviation. It means you're just deviating too much. Okay? So, I'm not going to spend time explaining how investors in different sectors behave, because I think you all know that, you've seen enough of those slides. But the important thing is, how do we manage risk and how do we reduce risk? Because that's all they look for, is the risk and reward. And I think this is an important area where things have changed again in the last 5 years. There has been shift, whether or not we've been measuring it or not, but it has been shift. Today, there are 3 different trends that are defining the way risk is taking shape. We have failing states, which are leaving behind a vacuum. We have strategic competition between strong states with conflicting interests. It's a very important one. So we have China and US. We have US and USSR. We have USSR and Europe. We have Iran, Saudi Arabia. The decisions they're making are not based on pure commercial economics. These are to do with political differences. And they're hurting each other, and they're hurting the markets. Every time Saudi Arabia and Iraq talk about, and Iran talk about conflict, it hurts the oil market. It introduces instability. So if you're in the oil market and you are a neighbor to, let's say, Qatar, you should be worried, because Saudi Arabia might attack Qatar. How many of you remember Gulf Sands? Anyone? Okay. So that's a story. Those guys were doing so well, 250, 300 million market cap, collapsed. Syria. They were producing in Syria. So it's very important to understand where your risks lie. Long-term impact of technological advances. Well, that's interesting, because technological advance should actually benefit us, but not necessarily. I mean, Gold Corp getting broken, having cybercrime introduced. Where's Bitcoin taking us? Is that going to hurt gold? We don't know. So there is movement that creates uncertainty, not necessarily one that one can quantify, but it's there. And unless we start to understand it and how it impacts our industry, we may be caught unawares. So, from an investment perspective, let's recognize geography has become a bigger consideration for investors. Funds. Now, by funds, I don't mean people's money, I'm talking about investment funds. Investment funds have much tighter mandates that drive and control their investment criteria. We have situations now where we have funds that say, I can only invest in this country, and this country, and that country. That's it. Why? Why would they do that? Well, simple. Because the people that comprise that fund have operated and worked in those specific countries, they understand them really well, and because of that, they'll be successful, much more likely to be successful in those countries than anywhere else. So the people who gave them money won't allow them to go and tie up that money in a country they've not operated. Again, if you don't understand that, if you don't know how they work, you might spend a lot of time talking to an investor who's never going to invest in your project. Sanctions. Well, that's an interesting one, because you might invest in a company and they become part of the SDN. So how do you deal with that? China dominates the minerals market, and they've imposed lots of legislation locally that impact the way in which minerals are traded. Cybercrime on Gold Corp, as I mentioned before, has shown us the need for mining companies, especially those who actually can afford it, to start spending time and money protecting themselves against this. And I didn't put anything down on Bitcoin, but I actually think that that's an area that they do need to understand. So, how do we learn from this, or how do we protect ourselves and make the mining sector what it used to be, a heavily invested in sector? Well, I think the next project you look at it from an investor's perspective. Try to reduce those risks, because a risky project, unless it has massive upside, isn't really an interesting project. Align your strategy with investors before you start your project. A lot of people start and they lose their way. If you can't, then okay, it's easy to say align your strategy with an investor. But if you don't spend the time at the right time thinking about that, it's going to be more painful later. Consider the political risks. That's a difficult one. But there are some easy places where you know already you have problems. You look at your neighbors. You don't have to necessarily be in a country that has the problem. If you're neighboring a country, just look at Turkey, for example. Right now, any project that is in Turkey, near the Syria border, doesn't get invested. Simple. So take care where your project is located. How do you protect against China? Well, try to have a plan B or a C in your offtake agreements. You can't always be dependent on just one offtaker. And try and leverage the skills and technology that is available to reduce that risk. And when you've done all of that, you can actually start to do some mining. As I said, short and slightly punchy investment. I'm happy to take questions from anyone. I'm sure there's some people who disagree with me, but there you go.